Hey guys, it's pretty crazy start to the year with the tech sell-off that we're seeing. We're seeing a lot of selling in the healthcare, but we're now starting to see a capital flowing into the energy stocks, into your financial stocks. You're also seeing it with the industrials. You're seeing it with the materials play. So is it time to just basically throw our hands up in the air and move on from all the tech stocks, the stocks that have worked so well for 2021, but now in 2022? Are we going to start be looking at these small caps? Are we going to start looking at more of the industrial plays, infrastructure plays? So we're going to go through a ton of charts tonight, and it's great to be back. I took a little bit of time off there at the end of the year. It's been a very fun and exciting year, but also it's pretty good to recharge those batteries a little bit by spending time with a family. So I'm happy to be back and looking forward to a great 2022 with you guys, where we're sharing just a ton of ideas and really figuring out this market together. So real quick, let's go ahead and look at some of the charts right out of the gate. We're going to start with the indices, and then we'll go ahead and start looking at, from there, we'll start going ahead and looking at the some of the individual sectors and the industries that are moving them. First off, SPY. And don't forget too, I'll be taking all your questions, and we'll go through your charts and questions that you guys might have. I'm here to help you guys. But first, SPY. Oh, make sure to hit the like button too, man. Guys, that helps me with the channel. SPY continues to bounce off of this rising trend line. We've highlighted that a number of times in the past if you forgot. But we've seen this consolidation over the last 6 days. Consolidation, we hit new highs today at the market open, and we pulled back. And we pulled back pretty hard there right out of the gate. We saw the small caps hold up decently well, but that selling was really concentrated in healthcare and tech stocks. In fact, most of the day we were seeing positive breadth out of the market, but we were also seeing like 8 out of 11 sectors trading higher. So under the surface, you would think the S&P 500 was up like 15 to 20 points when it was actually down. So overall on the day, it had a little bit of a late rally followed by a 10-minute sell-off there at the end. Put us right back just below break even. So right now, what we're wanting to look at, we have some resistance overhead here. We're not really threatening those just yet. So that's not really in play at this moment. But what is in play? Do we break the lows from Monday, from yesterday? Do we pull back to this 470 level? That would be my first area to look for a bounce out of this market. If that doesn't hold, then you got this 50-day moving average that's rapidly rising. That it's kind of been hit or miss the last 2 times. And when we go below it, we close below it, but we quickly recaptured either the next day or a couple days later. That's not overly unusual from what we have seen in the past. Most consistently, we saw it in like July, June, May, March, and February of last year, where we would even sell below it, close below it, and then bounce the next day. We had that again here in December. The outlier is this big old episode right here from September and October. We traded below for quite some time and then quickly rebounded it. So the 50-day moving average doesn't come into play. Watch this rising trend line. We consistently are bouncing off of this thing, and it's quite amazing, honestly. I mean, we just continuously bounce off of it. So watch this. Watch this support level here at 470 on SPY, and then again at this. I mean, if we were to go straight down tomorrow, it would probably be around 456, 456, 457. So one of the sectors that are moving the S&P 500, one of the big players today was the energy sector. Now, this is the Spider ETF. I don't think it's the best barometer for measuring the entire energy sector, because if you look over here on the bottom of your screen, you only have like 21 stocks that are in the XLE ETF right here at the, well, you may not be able to see it. Yeah, you can. Yeah, right at the bottom there, it says 21 items in the watch list. That's how many are in this particular ETF. So it's not all the energy stocks. A lot of people confuse the Spider ETFs with like the entire sector. That's not the case. So XLE, it went up 3.4%, but the actual sector itself was up 2.3%. So there's a little bit of a discrepancy there. You follow me? So big move out of XLE. Check this out. Breaking some significant resistance there today. But then when you go to the actual energy sector as a whole, this was a breakout that I mentioned on StockTwits, broke above it, pretty significant here, I would say. There you go. Broke out of it yesterday, followed through on it today. So that's really the confirmation signal that you want to be staying long on it right now. I have one energy stock in my portfolio. I'm in Hess. Really good so far. I took a little bit off the table today at around 81, made about 6% off of it, got in late yesterday. Really, really strong sector as a whole. I'm really liking what I'm seeing so far out of energy. Now, you may start seeing a little bit of a correction as we go throughout the week in terms of like maybe some consolidation or a 1 to 2% pullback, because it has had a pretty good run. I've said this in a lot of other live streams. You don't want to be trying to chase well after the fact that the rally has already been established. What you want to do is trying to anticipate, get in at the early stages of a breakout, because when you get into those early stages, you're able to keep the risk a lot tighter. So yesterday would have been a good day. Getting in here at the close around like 81, 82, not the most ideal opportunity, but overall, I do like the energy sector. I think it's shaping up really good. This is the Spider ETF. This is the energy sector as a whole. Now, when you look at the financials, what do you got here? You got a double bottom. Double bottom confirmed when it broke above this 1976 level on the sector watch, or on the sector chart. Made a nice little bull flag here, and then it just took off. Very similar to what we saw with the energy. So really, really good. And again, don't forget, post any questions or stocks that you want me to go over, and I'll be happy to answer them for you. So financials, watch this little area right here. It's going to get a little bit tight probably if it starts to get back towards its all-time highs. So incredible run though, right? I mean, look at this off of the COVID lows for even the financials. More than doubled. So a couple of things we want to go ahead and look at. We want to look at the tech sector, because that's where a lot of your weakness stemmed from today. And when tech's weak, it's going to weigh on the whole market. Why? Because Apple, you have Microsoft, you have Google. You're talking about right there over $7 trillion of market cap between those three stocks. You throw in Facebook, that makes it 8 trillion. You throw in Tesla, that's 9 trillion. So you got 9 trillion between just a handful of stocks. You throw in Amazon, that's another 2 trillion. You're up to $11 trillion of market cap and just a handful of stocks. So when those stocks are not doing good on the NASDAQ 100, it's going to weigh not only on the NASDAQ 100, but on the composite, and also with the S&P 500 as a whole. So tech sector is very, very important. Huge support level here right now. Now, how does technology sector chart that I'm showing you right here compare to XLK, for instance? XLK down 1%. Technology sector down 1.6%. XLK only represents 76 stocks. Technology sector as a whole has like over 1,000. So a lot more to consider. You got to watch this support level. And this is a TC2000 platform. There's a link for it down below if you're interested in getting it. That's the chart system that I use. I think it's really good. If you ever have any questions, I'm more than happy to send you guys my chart layout if you guys need it. But watch the support level right here. That's going to be very key going forward. It did break this declining trend line, short-term declining trend line off of the November highs, broke it, but we're still not necessarily putting in a higher high. It bogged down when it tested these December highs right here. So a little bit of resistance, needs to break through it. Not doing that right now. So let's see if we can't test this 10.5 level on tech. All right, let's see here. Can I look at AFRM and SQ? I sure can. And I'm going to just sprinkle in some of y'all's charts as I'm going along here tonight. And I'm trying a little bit different times just to figure out what works best for everybody. I know everybody has different schedules, so bear with me. But AFRM, and I've been seeing this one come up in my question box a lot lately. Rising trend line, I wouldn't call it like necessarily the best rising trend line, just because it got so disattached from it a while back in August, and it hasn't had any real retests of it in quite some time. So you got this big support level, broke below it. Now you're looking at testing this rising trend line here. So far it's holding it, but I wouldn't call it necessarily a true test at this point. Let's see, what else do you guys have here? SQ. Well, real quick before I move on from AFRM. Breaks the support level, I don't want anything to do with it. It breaks below 77.50, I'm probably out of it at this point. And it's going up each and every day, this trend line. So your line in the sand is going to gradually go higher as well. But right now, if you're long on AFRM, you're needing this support level to hold. I mean, that's an absolute must. And we got SQ. So I'm in PayPal as well right now. And PayPal struggled today, but not nearly as bad as Square. Square was selling off all day. That's part of what we're seeing in software right now. And I'm going to get to the software charts in just a second. But over time, software or SQ has really been putting in just a massive topping pattern here, guys. And it confirmed it back in December. And that was something that not a lot of people really talked about. But this was a massive confirmation of a topping pattern. This should have been anybody's line in the sand here. And what you got to be careful of right now, that you're not trying to buy the dip or catch the following knife on this one, because there's many times where you could have been tempted to try to catch the falling knife. You could have been right here at 179, but now it's at 156. So you're trying to avoid this kind of like unnecessary heartache by trying to catch a falling knife. Because oftentimes when you try to catch a falling knife, what do? You grab it by the blade instead of the handle. Sometimes you'll get lucky and grab it by the handle, but nobody's actually good at doing that on a consistent basis. So in the process, you're going to get yourself cut up really bad. So there may be a base here trying to form. I mean, it kind of snuck just below it, which gives me a little bit of hesitancy there to say as much. But I would stay away from SQ right now until you can really get a good base. For me, right at this point in time, it would need to get back above 172 for me to gain any kind of interest. And that means it needs a rally about $16. Pretty significant rally. So what I would want to see goes right back up to this 172 without breaking over it, consolidates some, and then pushes right through it. So there's some work to do on SQ. Now, the difference between SQ and PayPal is actually sitting on some support here, going back to like July of last year. And it's forming a nice basing pattern, something that SQ has not been able to do just yet. It broke out of it yesterday, which gave me a little bit of excitement, but then it fell back below the base breakout. So now we're kind of in this like, I don't know if it's going to work out or not. If it doesn't work out, I got support right here. If the support doesn't hold, I get out of the trade. That's the nature of trading. You manage the risk. If the trade doesn't go in your favor, you get out for a small loss and you go on to the next trade. Just like with Hess right now, I'm able to book some profits in Hess because it's actually working out. What I don't want to do is Hess to have a sensational run, and then PayPal, I don't use any risk management on it, and it has a sensational sell-off, and I didn't make any money between the two. So you want to make sure that you're letting your winners run while you're cutting those losers short. I have not talked about Tesla or GM or F yet, but I will do that here in just a moment for a stock operator who is asking. And but what I want to do right now is go into the software industries and really show you guys just how problematic it's starting to look for some of these software stocks. Now, check out software application. Okay, a lot of these stocks are going to be like your Adobe, and if I type it in right here, there we go. This is going to be a lot of your I'll show you a list of it right now. This is like Salesforce, Shopify, SAP, a lot of really, really big companies. But what are you seeing with this chart? Massive topping pattern, massive double top here, guys. First top, second top. Now, let's draw a line across. What are you seeing? It's testing a major support level here. If this support level doesn't hold, it's going to get ugly for software stocks as a whole. I would not want to be in a software stock with this thing confirming, because it's showing that there's a top that's already in place. And you're saying, well, maybe it bounces off of it or something, or maybe it goes right below it and then it goes right back up to all-time highs. That's a possibility. But look at Square. We talked about the topping pattern in Square. That one did confirm, and it kept pushing lower. Another 25% lower almost. It confirmed at 200. It's now at 156. That's significant. So software, you want to watch this big, big support level here. First top, second top, double top pattern. And it's not just software application industry, but it's also software infrastructure as well. You see here, what is the most noticeable thing when you're looking at this chart? There's a pattern there. It's a bearish pattern, and it stands out like a sore thumb. At home, you should be saying, screaming, head and shoulders pattern. You got your left shoulder, you got your head, and then you got your right shoulder. You connect these dips on the pattern, and you got your neckline. So this neckline, it goes all the way back to about July of last year. Head, left shoulder, head, right shoulder, sitting on the 200-day moving average. It starts to break down below this neckline here. You have a confirmed head and shoulders pattern. Now, I will say over the last like 10, 11 years, what has it been since the Great Recession? I guess it's been about 12 years. So 12 years, these head and shoulders patterns have led to a lot of bounces, but it doesn't mean that it can't work. That's what you want to be aware of, is like, yes, this could be just a massive bounce opportunity for software infrastructure, but you also want to realize the historical importance of these bearish head and shoulders patterns. They represent a lot of distribution that's been taking place. And in the case of this one, this is a massive long-term pattern going all the way back to July of last year that it's been forming this. There's been a lot of distribution within this industry of the tech sector. Now you're thinking to yourself, man, well, software, which is a huge component of tech, if it's doing so bad, like it's just not going anywhere, why is tech doing so well? Well, first, Exhibit A, Apple, right? You get Apple going, that's going to help it out quite a bit. You got others within like the NASDAQ. You got like Tesla. That's going to help it out a lot as well. It's not necessarily considered tech. It's considered discretionary. Nonetheless, though, there's a lot of parts of Tesla that affects other stocks as well. If you got Facebook, that probably like what? Since September, it's been trading sideways. So that's been weighing on the tech sector. But you take Amazon, that's also not in the tech sector. It's in your discretionary. It's been trading sideways. So these things do have a little bit of an impact on the NASDAQ 100, but the one stock that's not going to, that can just trump it all basically is Apple. So you got Apple, plus you got Microsoft. Microsoft has been really good up until like the last month and a half where it started trading sideways. You also have Google trading really well up until about the last month and a half where it went sideways. But overall, it's helped keep tech alive. Now, the other one is semiconductors. Semiconductors as a whole has been very strong. It's been a bit choppy over the last 1.5 months, but it's helped camouflage a lot of weakness that we're seeing in the software stocks that should have been playing a much bigger role in how the tech's charts look, or like the NASDAQ 100 or the tech sector as a whole. But instead, just a handful of stocks or like the semiconductors as a whole are helping keep tech alive and camouflage a lot of the weakness that's under the surface. Let's look at Snow here. And I haven't forgot stock operators yet, but since we're talking about software, let's look at Snow. Check this out. I actually was looking at this as a possible trade setup yesterday, and I pulled it just because it did not work at all. So I never got into it. I was watching this rising trend line here. You can see we've tested it here. We've tested it again here. And so I said, okay, maybe we're going to bounce off of this thing. Okay. Now remember, I haven't seen at this point when I'm coming up with this trade setup, I hadn't seen today's action or yesterday's action yet. I'm just seeing, okay, there's a potential bounce here. Maybe we start seeing some of these stocks that have been pulling back over the last month or two start to get a little bit of action. I also wanted to see this declining trend line break as well. So I never got into it because I didn't get the confirmation. It didn't break above, this like 350 level to get long on it. I had a stop loss, I think around like 329. Once I started seeing this kind of price action, I don't want anything else to do with it because it's showing that it's not going to hold that stop loss very well anyways. If it's tested, which means I need to move it lower. If I move it lower, the risk became too much. So I moved on from the trade. Now, if I was in the stock, what my thought on it at this point is I don't like this rising trend line being broken. So there's got to be a line in the sand at some point, right? I mean, you've got support right here. Maybe it's holding that support level, but I mean, that's sketchy at best. I mean, it goes way below it. If you're if you were going in today watching this support level and it breaks, you should have already been out of it because it broke it intraday. In fact, if you zoom in on it a little bit, it looks like it might be just a shade below it. So I think the stock looks ugly. Doesn't mean that you can't get like a temporary bounce in the short term, but if you're trying to be disciplined as a trader, you can sometimes hold out for too long, hoping for that bounce that doesn't quite come in the time frame that you expect it to come in. Stock operator asks about Tesla, GM, and Ford, and we'll knock out all three of those. Tesla broke out of this bull flag pattern. Really, really impressive move. It, beat its Q4 deliveries resoundingly, and as a result, gapped way above it. I mean, I think it moved like 12% or something like that yesterday. Crazy. Pulled back about 4% today. Not all that shocking considering the kind of move that it made yesterday for it to give back up some of those gains, especially when you had a weak tape as well. But what you want to be careful about is that you're not chasing the stock. I wouldn't want to be jumping long on Tesla at 1,200. Now, if it pulls back to this rising trend line here, which I'm not sure it has any plans on doing that anytime soon, if it pull back to like 838, 840, yeah, that could be a pretty good opportunity. But that's really not in the here or now. So really, the play on Tesla was to play the breakout of the bull flag. The problem with that is that it did not do that. It actually broke or gapped above the bull flag and it just kept on running. So it never even pulled back to retest it. So you don't want to chase something just for the sake of like you wanted to get in and the market had other plans. You just got to move on to the next trade. That's very hard to play these kinds of gap ups because so often it'll fill it and it may still fill it. I mean, it got into the gap a little bit today. And it's getting a little bit messy when it gets up into this price range here. You can see it's at a price area where it does tend to pull back. It pulled back here, here, and here. So good chance that we see a little bit of selling going forward, especially if the weakness and the futures are down at the moment. That doesn't mean they'll necessarily open up tomorrow down, but at the moment they're down. And we've seen plenty of times where Tesla can really take a beating, especially if there's some news that's coming out of Elon's mouth. And let's look at GM and F. Both of them having huge days today. GM breaking above major resistance here. So you want to see, okay, can it continue to run above resistance? I wouldn't be surprised to see a little bit of a head fake right here because, I mean, look, it's gone from 53 to 65. We're talking GM here. That's a big move. I mean, that's a 20+% move. So wouldn't surprise me to see a little bit of a pullback there. So that could happen. Just I wouldn't go chasing it here. I would wait for a new pattern to evolve that allows you to better manage the risk because at these levels, you can't really do that. It's kind of like Tesla. You can't chase these things. You just got to kind of move on. And then what do we got? We got Ford. Definitely don't go chasing this one at this point. Like I said, it doesn't mean that it can't keep going higher, but you're not able to manage the risk. Now, if you're in it, and I hope that you are, start looking at ways that you can increase the stop loss. Now, another thing to do, if you're worried about losing the gains, take a little bit of profits off the table. That's not a bad approach to trading. It really saves you a lot of times because so many times we have these expectations for stocks that are never fulfilled. So many times I see a stock, oh man, I'm up 10% on the stock. I bet you it goes up 30 or 40%. Almost every time I ever think that, that's usually the top in the stock. So I'm glad often, more times than not, that I take profits along the way because you never know where that top's going to be, where the trade kind of peters out and it's no longer really a trade you want to be in. At least you were taking out profits along the way. So if you start taking a third or a half or even just a quarter, you're going to be much more comfortable with the trade because that also represents not only the profits you're taking off, but you're also reducing your risk on the trade as well. So yeah, so with Ford, I drew this just a moment ago. That was kind of like a breakout. I hate kind of playing breakouts with a resistance level that's on the I'll do it on this side. I got to do it on the opposite side, but I hate doing breakouts that require you to trade off of a resistance level that's on the incline. I'd rather do it on the decline or more preferably just a sideways breakout. So the big play, I mean, up to almost 12% today. Don't go chasing it, but yes, probably a good time to start taking some profits off the table. For me, at least I would have my stop loss at below today's lows. I mean, like 22.40, because you got to ask yourself, if it goes back below here, that chart is not going to look that great at this point. It's going to look like it's trapping a lot of longs and a lot of people who chase the stock, and it's going to probably create a little bit of a panic. A lot of people probably bought right in here when the stock opened up today, so they're at a higher risk of being trapped in this trade. Good volume, though. I am all over on the comments here. I got to try to be a little bit more systematic about it here. All right, Ollie asked about, are we going to see a Bitcoin bounce anytime soon? In order to do that, guess what? I need to go over to my other chart, see if I can transition here correctly. There we go. And there we go. All right, so on Bitcoin, let me get my Bitcoin pen out so I can draw on here if necessary. But what I want you guys to see, there's a head and shoulders pattern here that's forming, okay? And this is kind of a little bit of a concern. There's your head and shoulders pattern. I would be a little bit nervous about that going forward. And when you zoom in on it, guys, this thing is trying to break below it. This is your neckline. Now, the one good thing about it is that you have this support level, and I don't know if it's going to let me draw it here or no, probably not. But all right, I'm just going to have to extend it out kind of crappy here. But you got a rising support level underneath that may catch Bitcoin's fall. But that's going to be extremely important that if this head and shoulders pattern confirms and it goes down, it has got to hold this level right there. Okay, guys? So that's my analysis on Bitcoin. It was a little bit crappy here because I'm still getting used to the TradingView platform here. Other ones to watch here, you got Ethereum, a little bit of a bear flag pattern there working. I'll highlight that for you guys. You want to be watching that on Litecoin. Really, I mean, this was one that everybody was talking about back in, I think it was like November. Yeah, about mid-November. It just completely fell apart here. This is going to be a key support level for Litecoin. Needs to hold that level, or we're probably going to see a retest of what we saw back in July. So, all right, let's get back to the other charts here. You are, and I hadn't really planned on going through any of the Bitcoin charts tonight, so my apologies for that, kind of looking a little bit rough on that, on the edges there. URNM, we got a Uranium Mighty ETF. Not really familiar with this one. Can't say I've ever traded it before, but on the onset here, I'd say check out this 200-day moving average. It keeps seeming to like hold that one pretty well. Held it again at the end of last year and has bounced since. Now, a little bit of a declining trend line there. I wouldn't say there's a lot of points where it's tested it before and rejected price, but you're seeing a little bit of a breakthrough here today. Yeah, I think I just don't see this as probably being the best reward to risk opportunity. I mean, you're taking on over like 12, 13%. So that means you need about 26% of upside to justify the trade. So you need it to get back up to 100. It's possible, but I don't know. I think there's probably going to be better opportunities out there. I would be more patient with this trade setup. GOGL. Asking, is this a good play? I think it'll be a $20 to $40 stock. Remember, you can make predictions about stocks, but remember, so much of a stock's movement is going to be contingent on how the overall market's doing. So if the market's going to be poor, it's going to weigh on most stocks. So I would say somewhere about a 50 to 60% of stocks price movement is predicated by what is the overall market doing. Beyond that, then it becomes 20 to 30% guided by the sector in the industry, and then the rest of it's really just based off of the stock itself. But I will say this: I mean, it's incredible rally. I mean, it hasn't even had a down day since December. What is that, 14th? So yeah, it's incredible rally. Sustainable? No. I think at this point, I would want to be taking some profits along the way, especially as it's testing some resistance here. It is a double bottom pattern. You got your first bottom and your second bottom. Confirms it, with a break above it tomorrow. It tried to do it today, but couldn't hold that move above resistance. But, if it gets to $20, that's great. I just don't know. I can't really tell you if that's what it's going to do. I mean, $40, that's probably a stretch unless you just have another amazing year for the stock market. So good volume coming in over the last 2 days. Just be careful with unrealistic expectations. They tend to burn you and cause you to stay in a stock that you don't want to, or stay in a stock longer than you should. I can take a look at Walmart here for Mr. Nate Moore. He says it looks like they are in a symmetrical triangle and got rejected at the trend line today. Thank you. All right, let's look at Walmart. So you got a lot of resistance right here above. That's going to come into play at around 151. It's not in the here and now. Walmart tends to be one of your slower movers. The triangle I'm going to guess that he is talking about is that right there. And so, yeah, it got rejected at it. While it's stuck inside this triangle pattern, I don't think it's a play. I think it becomes a play once it gets out of that triangle pattern. Then it becomes a long position. At about 145, if it was to do it tomorrow, then you got to deal with this massive resistance at 151. So you got about $6 of upside. Now, what is the downside on it? Well, I'd probably say a close below this rising trend line or even a break below the rising trend line be enough for me to get out of it. So like 140 would be the risk. You're trying to get in at 145, but you only have about 151 in a 60 cents to the upside. So you're not even getting like a full 1.5 to 1 ratio there. I don't think the reward to risk ratio at this point justifies a trade. If you get in at right here, yes, your reward to risk ratio improves, but are you necessarily getting in at a point that says the stock is going higher? No, because this thing could break to the downside too, and you just took a unnecessary loss that was entirely avoidable. All good questions, guys. Thank you, Nate, for that one. Daniel asks about SSL. So this one definitely has, some action on the overseas markets. So that's why you have so many gaps on it, because it's primarily traded or listed on another exchange overseas. But double bottom here, it needs to hold this support level going forward. Kind of curious, though, why it wasn't up today. I don't know much about this particular stock, never traded it before, but kind of curious why it wasn't up when the entire energy sector was up. So that should be your first homework assignment after this, is check out why was SSL not up? Like, why did it not participate in the energy rally today? Because pretty much everything energy related participated. The other thing is 1831, you're going to run into some resistance. So I would probably be more concerned with finding maybe a better energy play that's still offering some good trade setup opportunities. I'm not seeing it in SSL, because for me to get long, it would need to get above 1836. It's trading at 1650. That could be a while. And then in the meantime, you miss out on the whole energy rally. All right, one person asked about SQQ. This is basically pro ultra short of the NASDAQ. Now, one thing you want to be careful of is there's a massive time decay on these things. It resets every night. So, you can they have to constantly do a reverse splits on these things. What was it? 2016, when you account for all the reverse splits, it was trading at like 2,300. These are not long-term investments. Not something you really want to trade unless you're very comfortable with it, because it's going to give you a 3-to-1 return of the inverse of whatever the NASDAQ 100 does. So NASDAQ drops 3%, you'll make 9%. NASDAQ drops 1%, you'll make 3%. If the NASDAQ goes up 5%, you just lost 15%. So lots of volatility. Over time, it does go down. But I don't like to go do technical analysis on the ultras. I base my analysis on the Qs when it's SQQ. If it's like UPRO, which is not the inverse, but just the 3-to-1 return of the S&P 500, I'll do my analysis on the SPY, because this is just a reflection of the underlying index that they're trying to reflect. So when you're looking at SQQ, it's better to look at Qs and base your trade off of what you're seeing with the Qs, not necessarily SQQQ. So on the Qs, trading sideways, right? For basically about a month and a half. That's similar to like the patterns that we were talking about with Google, with Microsoft, just very much dependent on the big tech FANG stocks. So a lot of consolidation here. I think for now, until we can get a little bit of a, basically I'll go clean the slate here, but we're essentially in a range. This is your range. And it's been stuck in there for about 2 months, almost month and a half. Until it can break to the upside or it can break to the downside, you're just looking at a lot of chops. So maybe SQQ works, but I would, if I was to hold it overnight, and that can be a kind of a scary thing, 380 maybe where it finds some support and it bounces back up. So you want to be careful there. Good stuff though, guys. Really enjoyed this session with you guys. Remember, it's a long year ahead of us here. I think there's like 250 plus trading days in a single year, or give or take a few days. But you don't have to make your entire year's gains in one day. You want to be more of like the tortoise and not the hare. You want to try to make steady gains as the year progresses, because those will compound over time and make all the difference. I apologize for my raspy voice. That's just a little bit of a cold that I've been dealing with over Christmas. It's getting better. And make sure to subscribe to this channel, guys. That is huge for me continuing to grow this channel. And make sure to check out the YouTube membership down below by clicking on the join button. You'll get all my market research each and every day. Thank you, guys, and God bless.